Yeah, as we think about the current conditions and the impact that these trade tensions that have recently escalated between the US and China are having on markets, I think it is a pretty key component of where we're heading. Now, when we think about this broader backdrop, we still have relatively positive economic growth conditions in both the US and China, clearly, but more broadly, the global economy. So the question is, what impact are the current tensions going to have on pulling back or being a drag effect on the economic growth? Right now, we expect it to remain relatively contained. So between 0.3 and maybe 0.5% of GDP detraction from growth. Now, any further escalation from here, and that clearly becomes a more dynamic situation that potentially does more damage to economic growth. You know, in terms of markets, we actually think that the impact has been a bit more pronounced and a bit different in the different markets. So what I mean by that is looking at fixed income markets, this very strong rally that we've seen in US fixed income markets, particularly if you look at the 10-year Treasury. Just 7-8 months ago, we were sitting at nearly 3.25%. Today we've seen a substantial reduction in yields, and we think in many ways the bond market is really discounting a more protracted outcome or a more damaging outcome than what we're seeing today. Now, in contrast to that, equity markets are still positive year to date. They've come off their highs recently, but not in a way that we think is, say, discounting that same kind of downdraft that maybe US fixed income markets are. So it's a very interesting time from that, how our financial markets, they're not discounting the same dynamic in our opinion. Now, going forward, we want to be very aware of any further escalation in tensions. We want to be aware of the ability of companies to manage through either the direct cost of tariffs or something more indirect. How are these trade tensions starting to disrupt corporate supply chains, and how are our companies able to manage through that? So I think those are important factors that we're going to have to watch. And you know, certainly if markets get more volatile and start to decline in terms of equity market declines, that certainly could also ripple through, start to impact consumer sentiment, start to impact business optimism. And those are things that we'll have to certainly pay attention to and evaluate as we move forward. So in terms of our outlook for potential of different sectors, one of the things that we really pay attention is the relative performance of different sectors. In certain market environments, you don't see extreme changes or differentials in performance of sectors, but right now we are in fact seeing very substantial differences in performance from different sectors. So example would be in this period of rising tensions and concerns about growth, we've seen some of the stable, more defensive sectors like utilities and real estate and consumer staples really outperform. That's given us some concern about valuations in those sectors. On the flip side, we've seen some of the more cyclical sectors retrench a bit more, certainly parts of of information technology, financials, energy, underperforming a bit more. Another sector like healthcare, which has underperformed, looks very compelling to us because of the stable underlying dynamics in that sector. So I think we're seeing a bit more of a opportunity to take profits in some sectors that have really benefited from volatility coming back into markets, and to reposition very targeted way into other sectors where we think fundamentals will improve as we get through this period of volatility and ultimately see the economy continue to stabilize and ultimately grow into the next year.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。